It's not required. Okay, so you got your amount available to your common stock. Then the stockholders' equity, and it should be listed for you there, total stockholders' equity. Take out your preferred stockholders' equity to get common stockholders' equity. And you should have all that information on your statements. You just signed it and performed the function, okay? So now we have our equity. Then we divide it. Take your dividend or your income available over the equity that the stockholders have, and they get. And it ends up being 19.4% return on your common stockholders' equity. Now that's a good return, right? For your common stock, they're going to say, "Well, yeah, stock's going up, good return." All right. Then we're going to go in our earnings per share. Then we look at our income available divided by the number of shares, and it gives you the earnings that are available per share, the earnings per share of common stock. This is something they watch very closely. Is that company earning earnings that would be available to the common stockholders? And they may pay out dividends to the common stockholders. It depends on the board and in stockholders.
And if they are, it shows a good sign.
Good sign if they're earning per share. If they're showing a good increase in their earnings per share. Okay, we've done these 3 steps. Here's our income available. 7,000 shares were out for this particular company for 12 months, right? And then we had 1,000 shares out for 3 months, which gives us 250 shares for the year to use in this calculation, right? Depends how long the shares have been active. We ended up with a total 7,250 shares that were active. Everybody with me? And then we divide the active shares for that year into the income available, and we get how much each share of stock, the yield per or the earnings per share. Okay. That's pretty good. How much was their stock per share? Does it say on their statement here? Let's look at it. Is it showing you the statement, or is it just pulling numbers out of the air? Where's the statement?
I think it's on here too.
Using the same one we were using? Oh, yeah. Probably. How much are the shares? They issued those shares at $1, right? A share? Whoa. That's pretty good. Okay. So the stockholders can feel pretty good about their shares. And the stock's probably worth more than that if it's traded on the market right now, because it does look like it's going up in earnings.
I was going to ask that. Why are such wild swings?
In the stock market? Now I'm going to tell you. Because they spread rumors, right? Tim?
The stock market is all about perception.
All about perception. And it's all about rumors. And by golly, they can change the perception in a flash. If they want to.
That's my second most favorite.
Sad but true, right?
That's why buy low, sell high.
Yeah. Okay, the other day, and other things that are factual, like Steve Jobs resigning from Apple, right? And it affected their stock, because people kind of got a little shaky about the management of Apple, right? It's just things like that. He started the place.
But then they fired him, and then they hired him.
Oh, yeah. I tell you what, they are doing something right? Everybody knows about Apple, right? The iPhones and all that.
But he's still going to stay on as a chef.
He's going to stay on as a consultant. But you see that sort of thing. Or if you're dealing in stock that has to do with, see, some people invest in projected corn market. Corn. Okay, and then all of a sudden we're getting a drought, or the projection of a drought or something, and it's going to affect your futures market.
Futures are up.
Your futures are hard. Cattle's going to be hard, but cattle, since everybody has dumped because of the dry weather, the people that held on are probably going to get a big return on their cattle sales in the next few months. Because a lot of people dumped their cattle during the dry. They had no grass or something, so they sold them. So now the people that held on are going to get a higher price in the market. But yes, that all has to do with that. It has to do with who's buying and selling in that market. No, it's not. You can't give horses away right now.
That's like someone was saying a horse market went down, so it should be expensive to eat.
No.
So like,
I didn't know they ate horses.
It's meat. Yeah, if they're hungry, believe me. It is.
actually had
If you got starving people, they're going to eat whatever they can get. They're going to get what they can eat. So, okay. No, we found out more than we wanted to do. They better not try to eat my horse. If you ever saw that movie, The White Stallions, anybody ever saw that? It's a true story about the Lebanon stallions in Germany that almost got wiped out because of hunger. And they saved them. Did you? Yeah. Joke. Anyway.
At least they didn't say dog.
Yeah. I tell you what. Or armadillo. I would get, okay. Back on topic here. Okay. So the price per earnings ratio compares the current market value of the stock with the earnings per share of that stock. So if we look at this and we get our little ratio where we got our earnings, and we look at the market price of the stocks, we can get a ratio. What do those earnings look like compared to the earnings per share of stock? Or for the, look like compared to the market price? Goodness gracious, this stock's selling for $144. 12-to-1 ratio, so it looks pretty attractive if you're earning that much more, right? Or it looks like the amount of shares out could project that much of a increase. Wow. Okay, let's go to the yield. We need to move on so we can do a little exercise I have. Dividend per share compared to the market price. And we're looking at the yield, and of course this is for your preferred, right? No, yield on common stock. Well, they must have paid a dividend to their common stock. I'm sorry, I was thinking about that other. Yeah, they must have paid a dividend to their common stock. So in this example, I was thinking about our problem, but they had a 10%. That's pretty good yield. How much are you getting in your savings account these days? Per year on savings, you may know. Yeah. Yeah, right. It's lucky if you get 1.2% on your savings account. 0.3. Well, that's it for 6 months, so you're getting 0.6 per year. Yeah. I can remember the days when you got 5 and 6% on your. Y'all remember? Anybody remember that on your savings accounts? And on some, when you buy it for when you buying it for like 6 months, way back when the oil boom was going on, you could get 19%. On a, what do you call that? I forgot what you call those things. I'm going blank. Yeah,
We were talking about that the other
the
day.
80s.
Banks here in town, that's 5.9% on CDs.
CDs, yeah, CDs.
We used to invest in CDs shortly after I turned 18. We were turning 23.
Exactly. Yeah, up to 23, 25%. Some of them. Yeah. And that was, you could actually make money by keeping your money, right? Now you got to put it out there on something and hope that it does well. Rate of return on total assets, okay. Income before interest, and income taxes divided by your total assets to get your rate of return ratio. And so, if your income, and then add back interest expense, because it is another expense, right? It's not part of the regular operating expenses, so you add back your other expense to it. Shows up on the income statement at the bottom. You hadn't had accounting too, so you might not be familiar with this, but you do add back in interest expenses at the bottom under other expenses, other income on your statements. Okay. So you add back your interest expense and divide by your total assets, and we'll come up, and then you get your ratio of rate of return on your assets. That's pretty good too, 16% rate of return on your assets. Okay, especially today. Okay, when you're looking at this, we're going to judge. This has to do with managerial performance. Why? Because the managers of the company decide whether or not to buy more assets, right, or to keep the money in the business, or what to do with the cash flow, the money on hand. So this is an indication. If you're getting a good return on your assets, that means they're managing the assets well, and not just going out there and buying themselves an iPad or something. Okay, so it's things that they may not need. Okay, maybe they do need it. You can also evaluate proposed capital expenditures by looking at this. We can say, well, they're proposing to buy some more capital investments, long-term assets or something. We only look at our income from normal business so that we can see whether we're going to have the money or projected to have the money to buy new assets or increase the size of the business. We make decisions based on these ratios. So they are very important. Net sales over total assets gives you your asset turnover. Why is that? What happens when you have sales? What goes out? Your inventory, right? Which is part of your assets. Okay. So we're going to look at the asset turnover. Looking at net sales. Example. If your sales were $2,965, your average ratio, your average assets or your assets are $555,711. That means you turned over those assets 5 times during the year. And we want, going back to our inventory thought, we'd want a turnover, wouldn't we? Keep it fresh, right? Remember we talked about that? Higher the ratio, the more effectively they're keeping that inventory movement. Okay. And that's a goal. It's a goal of our managers. And we're managing right now. Okay. So, let's keep going. We got a lot of these. Okay. Measuring financial strength. The number of times bond interest is earned. That shows you the strength of the company. The ratio of equity to total stockholders' equity to their total equities. And ratio of equity to total liabilities, and looking at your book value per share of your stock, which is, let's look at it. Measures the ability or net income to cover the required bond interest payments. So when a company has a bond out, you have to pay interest periodically. So you take your income before the bond interest and divide it by the bond interest cash requirement to get the times the bond interest is earned. In other words, am I earning enough to pay my bond interest? How many times did I earn enough? First, we have to compute the bond interest and the income taxes before bond. Okay, cash. Okay, here we go. Compute the income before the bond interest and the income taxes, which should show up on your. You may have to do some subtracting. The income before your income tax. Add the bond interest expense to that. Because remember, it was taken out at the bottom, underneath the income. Available for the bond interest, $88,875. How much cash is required if we have 10% payout rate? We need $10,000 available to pay our bond interest. The bond was $100,000. So we're going to need $10,000. So, if we look at it, we earned enough money to pay our bond interest 39 times. So we're okay, right? We have to pay our bond interest, and that's what people that are investing in your bond want to know.